And welcome, this is Tyler again from Macro Ops to Lecture 2 in our price action course entitled The Value in Price Action. So, first off, we got to talk about the key difference between public markets and public investing and private investing, and that is the liquidity. So if you think about it, in public markets, you can sell and buy stuff instantly. Okay, within a day, you can short millions of euros and cover those euros within 5 minutes, even if you wanted to. This isn't possible in private market investing. So say you wanted to open a Subway or an ice cream shop or something like that, that's a relatively long commitment. It's going to be a multi-year commitment of time, energy, and money. And that's true of most business startups, anything in the private market. But in public markets, that's not necessarily the case. We have the luxury of liquidity, and we want to use that luxury to our advantage. So knowing that the game involves a feature in which we can buy and sell almost instantaneously, we want to take that and use it to our advantage, because it definitely is an advantage. And so that's why we have to know charts. And that's why we really have to study them, because the charts help us execute on a short-term basis. So what price action really is just a roadmap that's covering the history of investor psychology and sentiment. The chart is a collection of how investors responded to past landscapes and past catalysts. Okay, and then when we take that information, we can incorporate to our current outlook on the market and generate a definable trade structure from that. And this is absolutely information you don't want to overlook. So that's why we really need to know about charts. We really need to know about price action when it comes to investing in public markets. It's because we have the ability to execute on a moment's notice on any type of time frame. Now, there's three main areas of price action that we see that we can subdivide to talk about the advantages. So the first is from a timing perspective, which refers to when to get into trades and when to exit them. Then risk management, which is pretty self-explanatory. It's making sure we don't go broke. And within risk management, we get other sub-benefits like emotional management and big bets. And then finally, from an analytical perspective, we get something called the emergent property. And what the emergent property is, we'll dive deeper into it later in the lecture, but it's basically giving you a better context on what's going on fundamentally by watching the price action. So let's move on to timing. Timing is the most important part of trading, absolute most important part of trading, because you can be right, fundamentally speaking, but if you get the timing wrong, you're still going to go out of business. So imagine predicting the subprime crisis but placing your bets too early. All your research is correct. You've done years, months, days, weeks of solid research. You have all the due diligence on a mortgage crisis happening, but you bet a year early. You mistime it, your options expire, and when the crash comes, you actually don't get your huge payout. Your investors leave you. They can't hold on for the whole ride. So even though you were right, you went too early into puts and you were in what's called a dead money trade. We're going to talk a lot more about dead money trades. It's very key that we stay out of dead money trades. But this will leave you demoralized, underwater, and frustrated. And on top of that, you're going to lose out on all the compounding and the time value of money in the meantime, because if your trade's just going sideways and not making you any money, well, that's obviously an opportunity cost. So a good example of this was John Paulson's big trade. Now, he ended up getting lucky because he actually hit the move. But Paulson, as you can see here, I'll mark it on the screen, he started betting on this in July of 2006. Okay, when he bet on against the ABX, which is basically the index that tracked the subprime mortgage market. So his first bet was actually too early. It caused him a ton of stress. He had investors calling him up all the time, saying that he was straying away from his expertise. They were sick of slowly bleeding out money every month, and housing remained strong, and the fund continued to lose money again and again. Now, luckily enough, Paulson was able to get a second fund going, and he got that second fund going, and he was able to continue betting on the credit crisis. And then it eventually played out, and he made his billions. And the story and the narrative became, one of the most famous ones of 2008. But if Paulson, for example, waited until price action at least subtly confirmed that a move was happening, he would be able to cut a lot of time, energy, angst, and stress out of his life from beforehand. Okay, and this is exactly what we want to try to do. We don't want to sit in dead money trades that actually kill us emotionally and kill us from a time and energy perspective. So here's Stan Druckenmiller, one of our favorite traders of all time, obviously one of the best track records of all time. He traded for George Soros and Quantum, and he talks about this as well. So here's his quote: "I never use valuation to time the market. I use liquidity considerations and technical analysis for my timing. Valuation only tells me how far the market can go once a catalyst enters the picture to change the market direction. The catalyst is liquidity, and hopefully my technical analysis will pick it up." So what he's saying is he'll have an idea about where a market's going to go, but he's not going to take action on it until the technical analysis kicks in and says, hey, this move has potential to take place now, because Stan knows he doesn't want to be into dead money trades. That's why a lot of the time, people say that he flip-flops and changes his mind a lot. Well, he's just playing to what the game really is, and that's a constantly dynamic moving game that's very liquid, and he embraces that fact and is able to get in and out and flip-flop whenever the conditions line up to what he thinks is most probable coming up in the short to mid-term. So when entering the market, we want to take as little heat as possible and get paid as fast as possible. So what do I mean by that? Well, basically, when we want to get into a stock, we want to enter and then the stock to immediately shoot up and pay us. Okay, that's the best case scenario, right? Straight up and pay us, no heat. It's not going to roll off and cause us to sweat and then go slowly, or it's not going to come and go straight down. It's just going to go straight up and pay us. So by using price action, we can eliminate a lot of the scenarios, these scenarios that would cause us a lot of angst and pain as price trends against us or doesn't go anywhere. And we're going to be able to hit a lot more of these scenarios where we get the best case, the case that we're looking for. So it's not going to be something perfect, but we're just trying to filter down and say, hey, we like this trade, but we only want to take it at a time in which we think it will fire off in our direction immediately. So value investors suffer because they don't use price action, they don't use charts. And this is why you got all these guys on Seeking Alpha that say, something like a beaten down stock will come back from the ashes 5 years from now. Well, what are they going to do for those 5 years? Are they going to sit in a beaten down stock that gives them no money and doesn't pay them for 5 straight years? The strategy can work, and it does work, but is it as efficient as it can be? Because you're sitting in something that's trading sideways. It's not, it's not really performing for you. So why sit in 5 years of sideways movement when you can instead time it correctly? So they'll perform all this due diligence on companies to find positive fundamentals. They got all the signs that they look for. They got highly profitable, debt situation improving, but price could still be in a free fall, falling. And ignoring price, if they're never even looking at charts, they're buying on the way down, buying on the way down, buying on the way down, buying on the way down. And they're thinking that they're getting a better price and averaging down their cost basis. But how many months or how many years are you going to have to sit in a downtrending stock or a stock that kind of fizzles out sideways and doesn't pay them, right? Because that capital, it could be placed in something else that's instead moving quickly and higher. So they miss out on the opportunity cost of constantly being in things that are moving in their direction by not heeding the chart and the price action. So the alternative approach, if you're going to use price action and charts in your trading, is to identify value and then enter the position as the market begins to recognize that value as well. This reduces time spent in dead trades because you only get paid in the market when people recognize value after you recognize it. So just because you found the best play ever in the market, you think, oh, this is the best stock, or this is the absolute best thesis I've ever heard, and you truly believe it, even if you're right, you still do not get paid on that assumption or on that thesis until other investors start to take your side, right? Because if you think stock XYZ is going to go up, you think it has a great story and great fundamentals, you're relying on other investors to come to it late to the party and bid up that stock for you to eventually sell at a higher price. So even though the story is there and maybe the metrics are there, but investors aren't bidding up the price, then you're not going to get paid. It doesn't matter how good the thesis is or how compelling the idea is. We need people to follow us. So why not utilize charts and price action to help you time that point where investors are likely to come in and bid up your stock based on your thesis? So here's a great example of a stock called Novotel Wireless Incorporated. This is actually one of the stocks that we traded a while back, and you can see it had a big downtrend here, and then it started to look attractive from a fundamental perspective right in this area. So, one approach is, okay, hey, we can continue buying this consolidation area, but look at all of the mental angst and stress we have to sit through, right? Price is going up, we think we're right, then it's doing nothing, then it's falling, and at this point, you're sort of doubting yourself, and then it continues to go sideways. And keep in mind, this is over the course of multiple months. Okay, multiple months at the beginning of the year. So this stock's going sideways, kind of bumping around, and then finally it makes its big move and pays everyone right here. So it goes up from about 180 to around 360-ish, about 100% gain. But look, most of that gain happened in around 3 to 4 weeks' time. So if you take the approach of trying to time the stock, you can just buy it when it breaks out here and instantly go for the ride rather than have to suffer through all the angst of the consolidation area. Or even if you thought the stock was a good fundamental case right here, you would have been buying for over a year on the way down. And if you bought too soon, you wouldn't make the money on the spike because your cost basis would be too high. So if you're waiting for the consolidation for price action to tell you, you can be more aligned with making money on that eventual spike back up that you believe in because of a certain fundamental or situation or a catalyst coming down the line. So now the second thing, so that was the timing. Now the second thing we're going to talk about is the risk management. So obviously this is a huge topic in trading. Anyone in the industry constantly talks about this. It's risk management, risk management, risk management, because the market's job is to kill you. We all have finite bankrolls, so we need to manage this risk. It's absolutely crucial to stay in the game. So where price action can help us there is to create an exit strategy in advance to help us avoid any emotional jostling or decision making while we're in a position. And this is huge because you tend to burn your emotions out if you're constantly trying to decide what to do. So if price is trending lower after you're entering a long position and it continues trending down and down and down and down over weeks and months, that's a bad sign. Okay, that's immediately a bad sign. We don't need to study fundamentals. We don't need to study anything really more except for the price to tell us that something is wrong with our thesis, our timing, or both. All we need is this one simple thing called the chart to alert us that we have something wrong. And if we have a exit strategy in place beforehand, it's easy. We just exit. We die another day and we come back to market, we just exit and take our loss. Because the reality of investing and trading is that no one is 100% right. You are going to lose on trades. You are going to lose on trades, and we can't emphasize this enough. It doesn't matter, if you're $1 billion shop, those guys still lose a good amount of the time. And the old macro traders, they were happy with 50% win rates because they knew that when they were right, they were going to knock it out of the park. When they were wrong, they were going to try to contain losses and lose small. So it's natural to lose in the market. That's part of the job as a trader, investors learning how to take loss. So it makes sense then to have a proper process in place. So when you are wrong, you can get out, and it's systematized and it's defined, and you're not pulling your hair out because it's like, what do I do with this stock? I don't know. I'm down a bunch of money. You don't have to worry about that. So when you have a price action process or any type of technical system, you get a codified, reliable, mechanical process to control your risk. And so in effect, you got a line in the sand that says, hey, if the market reaches, this price level, it could be whatever, it could be $10. If it breaches that price level, I'm gone. It doesn't really matter what anything says, how I'm feeling, what I think, what the media's saying, what the guy on Twitter's saying, you're out. And that saves you a lot of time and energy, and it can really extend the life of your trading career. So the need to expend emotional capital on deciding when to exit is extremely taxing on you. And what happens is you get something called decision fatigue. If you every single day you have to say, it's 10 days have gone by and the stock keeps on going down. You say, should I exit? And you're trying to think and decide. And then 20 days go by, and then 30 days go by, and months go by. You're on month 1, you're on month 2, you're on month 3, and you're trying to figure out if you should exit this losing trade. You're going to start burning yourself out and get something called decision fatigue. So instead, we can outsource it to a mechanical process that basically is a crutch to help us just, hey, if it crosses this line, we're out. Because you only have so much decision power in a day. And we got to devote that to other things like finding new trades. Maybe you have other things in your personal life you need to pay attention to. You have other businesses, etc. If you're managing money, you got to pay attention to clients and the whole 9 yards. So depleting your emotional capital will have extremely negative effects on other areas of your life, and that's why we need to preserve it. And we see this type of stuff with guys like Zuck and Jobs, and this is why they're wearing the same clothes every day. This is a similar concept. So with Zuckerberg, he wears the same goofy kind of thing every day, right? He has this gray shirt every single day. He's wearing that, and then he has his jeans and his same shoes, and it's not that stylish. He looks all right, but hey, it works for him. It's comfortable, and he doesn't have to freaking decide what he wants to wear every single morning when he wakes up. That's one less decision he has to make. That's more T&E he conserves, and he can save it for more important decisions like where to move, a multi-billion-dollar company like Facebook, what to do next there. Exact same thing with Jobs, right? It's the classic black turtleneck with jeans and white tennis shoes. Looks like he had a little black right there in 2001. I don't know what's going on there, but anyway, Jobs did this so he didn't have to expend energy on this certain decision, and that allowed him to have more T&E for other types of decisions. So the same thing goes with risk management, is if we can codify it and define it, then we don't need to spend emotional capital and energy on that particular decision, and we can instead use it on more important things. So another reason, and one of the sub-reasons that we talked about with risk management, is defining risk goes hand in hand with betting big. And I'll explain this in a second. But at MacroOps, we're able to bet 200 to 300% notional on a single trading theme, especially if it's a currency or a U.S. Equity index, some type of future, because we have a defined risk system that doesn't count on the stock or, the future going to zero or something like that. We have a defined system that will let us say, hey, we're going to get out if this asset falls X%. And that way, we can put on large leverage and swing for the fences and still not have risk of blowing up. Your classic fundamental only investors who don't use price, they can never bet that big, because once they get in on a theme alone, a fundamental theme alone, and stuff starts to go against them, they don't have a way to get out. It might take them a long time to realize from a fundamental perspective that, whoa, this, I was wrong. And by that time, the stock could be down 50, 70, 90%. So that's why these fundamental only guys, they're going in with, 3% or so of their portfolio on a stock. And, some guys might bet larger, like a 10% if they have big balls and they're a big hedge fund. But unless you have a way to define risk via the chart or via technical system, you're not going to be able to bet big, because the second you're wrong, you're going to blow out. Taking giant positions, people say, wow, you guys are really high risk. You have huge balls. Do we have Oracle-like knowledge, that some fundamental only manager doesn't? Or do we have some crystal ball? Well, obviously not. Those are stupid questions. The answer is no. Well, except for our balls, those are big. But anyway, we use price action to define a point at which we'll exit a trade. Okay? So stopping out of bad trades prevents us from ever holding anything to zero. We don't have to worry about being in a stock and saying, oh my God, I'm going to ride this all the way down to zero. No, before we get in, we have a codified technical price action based system to let us exit the trade with grace if it goes against us. So the fundamental investors, they need to be prepared to lose everything if they're wrong, right? If you go into some type of stock and you really believe in the business and it starts tanking, well, you're not going to be able to react to it quick enough from a fundamental perspective to not, get your ass kicked and lose a significant amount of money. And they know that. And that's why they use such a small percent of their portfolio. So they control their risk through size, whereas we're controlling our risk And they control the risk through size and diversification, whereas, we prefer to bet big and control our risk with a price action system. Because we think in order to outperform in the market, we want to avoid what we call diversification. So we like having concentrated big bets with price stops because we feel like that's the best way to outperform the market. If you're not willing to do that, in our opinion, take big bets, watch the basket closely, you're just going to get average returns. You're going to be, just like any other index fund. And at that point, why play the game? If you want to just take a bunch of small positions in a highly diversified manner, well, they already got that for you, and it's extremely cheap. You can go to Vanguard, you can go to a robo-advisor, get a low-cost passive index fund, you take your 6-7% a year if you're lucky, and that's good enough, right? You don't need to play the game, because if you're going to play the game, you might as well go for greatness, right? No one's playing this to be average. So the more you diversify and the smaller positions you take, the less impact your trading decisions actually will have on your performance. And Buffett talks about that as well back in his early days. He needed to take big bets to really shine. If you just diversify everywhere, that's the opposite of having conviction on an idea. So price action is crucial to allowing you to make those big bets by closely defining your risk. And here's a good example about defining risk with something like Chesapeake. So, this is a little crazy stock here after oil got beaten down, but we can see that, it was down about $1.50, rallied all the way up to $6.50. So just an incredible gain. And then it comes back down from $6.50 to what looks like about $4 here. So this thing's crashing everywhere. It's going, up hundreds of percents. It's crashing, by 30%, 40%. And then it's chopping sideways, and it's, then it's rallying back again to 8 and going up another 100% from May right here. So how is it that we can bet big in a stock like this when it's jumping around by such a large amount? Well, we define it with a price action system. So in this case, I have this little ascending triangle drawn right here, and this is just an example. We're going to get into the meat of this much later in the course, but let's say we chose to time this by entering on this breakout bar right here, and then saying to ourselves, okay, our line in the sand is at a 15% drop right below this consolidation. So we say, hey, if Chesapeake trades below that, then we don't think this trend will continue up. We're not confident in that anymore, and it's more, if it breaks that, it's more likely to do more significant chop or perhaps reverse. So if we have about a 15% stop on here, well, we can take a much larger position because we don't have to worry about riding Chesapeake down to zero like some fundamental only guy might be worried about doing. So we can take a 20% position size into Chesapeake. And if we have a 20% position size in Chesapeake and it falls 15%, okay, instead of losing 15% of our portfolio, we only lose a fifth of that, which would be 3%. And all of a sudden, that's a tolerable loss. This is a tolerable loss that we can take on our portfolio level, and we still have, a lot of size on in this move. Right? We have, if this thing rallies 100% from here, we have a 20% position, we would make 20%. So we get to stay on with larger leverage and avoid taking the catastrophic loss because we're willing to get out when the price action doesn't line up anymore. And PTJ, this guy, he made billions of dollars with this concept. So he credits Elliott wave theory with great success. Now, we're not necessarily believers of Elliott wave theory, and a lot of people criticize him for believing in this type of technical analysis. They call it voodoo. A lot of the voodoo guys and the people in the voodoo camp scream at PTJ, said, that is complete BS. It doesn't work. But they're sort of missing the point. From our perspective, Elliott wave theory doesn't really have any special predictive powers, but it allowed him to define the asymmetric trade setups with the proper risk management he was looking for. So he was able to take the chart and set up situations in which he was wrong, he would be risking 1, and when he was right, he would be making 5. And he talks about this time and time again, risking 1 to make 5. So you can mechanically set this risk-reward ratio with a technical system. It's hard to do with fundamentals because fundamentals aren't absolute, right? They will tell you a general direction, but the stock rotates around the actual fundamental picture, and the fundamental picture changes in real time. So it's extremely hard to define this type of risk-reward ratio unless you have a price action and technical system to fall back on. And that's why Paul Tudor Jones liked to do this. He liked to use Elliott wave theory because he could line up trades and create setups where he was put in an extremely favorable scenario from a risk-reward perspective. So you might be thinking to yourself, is that it? All I have to do is draw a line on a chart and get out of it if it falls down? How can that give me any edge? And the reality is this type of risk management is an incredible edge because it's extremely robust and extremely reliable and extremely simple. Okay, and so just by following those simple rules and taking losses, which a lot of investors can't do, just the fact of taking a loss is an edge in itself. So it's based on pure price levels, not crazy volatility estimates, correlations, or diversification theory, because that stuff can all break down, right? That's all looking at past data, running it through math models and saying, hey, this is how the market behaves, so I'm going to model my risk assuming it behaves like that going forward. No, it's not saying that. It's pure price levels. So just saying if something goes from here down to here, we exit the trade. That's it. It's very, very, very simple. It's simple and effective. And a nice little metaphor in nature for this, or analogy in nature, was the cockroach. So the cockroach, everyone knows these bugs. They're impossible to kill. They're everywhere. You just can't get them out of your house, and they're constantly surviving the harshest of conditions. And they've been around forever. They're the champion of robust risk management in nature. They keep coming back again and again. And can you guess what their survival system is? It's extremely simple. And this is what they do. They literally just run the opposite direction of any gust of wind they feel. So you can see on they have these rear appendages called cerci. There's one. And they just detect air currents. So when they feel air coming at them from this angle on these appendages, they just simply run away from this air current. And so it's interesting because that very simple risk management system makes them incredibly robust. So they instantly know how to quickly get away from potential danger, and they're fast and they move away, and it works. It's worked for almost since the beginning of time. And that's a testament to how simple and robust is what really creates longevity. And it's just as true as nature as it is in trading. So if price doesn't confirm, we get out. We just get out. This completely lowers your odds of blowing up to infinitesimally small with this type of risk management system, and we develop somewhat of a crash immunity. We don't have to worry about sitting through a 2008 where our portfolio falls by 50%. We don't have to worry about getting absolutely crushed on something. We can control our downside, control our risk. And that is a huge saving grace when it comes to staying in the game from an emotional capital perspective. So the best guys in the game, the guys that we've seen be around for the longest amount of time, hammer this point home again and again. And here's a picture of a trading mentor that we really respect, Peter Brandt. He's been trading markets for decades. I think it's 40 years now, 4 decades he's traded. And he bangs the table on risk control through price action cues. And he's survived longer than many, many hedge funds out there, and he continues to thrive to this day. And it's similar to guys, all the old macro guys like Soros, Druck, PTJ, all these guys controlled risk in a similar manner, and they're still around to tell the tale. They're still here, and they're not blown up. So if you choose not to do this, and just let things ride, you can take big bets and not control your risk, but ultimately you will blow up. So there's no escaping this. Ultimately, you will go into a big stock. You can be the best fundamental analyst in the world and do all the due diligence on it, and if you go in big, it's gonna kill you when you're eventually wrong. And so Ackman's a good example of this. He went in big on a stock called VRX, Valiant Pharmaceuticals. And, he was highly convicted on the fundamental theme, and the stock absolutely fell apart. And it didn't completely cripple his fund because he controlled his risk a little bit with position sizing. But, he's exposed to these types of blow up risks. And if this one didn't kill him, the next one will, because eventually you will find a stock that takes you out and goes to zero, because no one's right 100% of the time. And it's only a matter of time when something comes along, you get it a little bit wrong. And even if it wasn't your fault, for unforeseen circumstances, something happened, like in the case of long-term capital management, they couldn't possibly see the type of crisis that was coming their way, but they didn't manage risk in a robust, simple way. So when they had these unforeseen risks, it caused a blow up in their fund. And this happens a lot with every beginner trader as well. They try to jump in, maybe they hit a penny stock and it goes from 1 to 10 and they get all excited. And now, they threw their whole account in that one, 10x their account. And then the next play, they throw all their money into that one and the thing goes to zero and they lose it all. So they're out of the game, right? They're gone. It only takes one devastating loser to completely take you out of the game. And that's why risk control is so important, is you're only one catastrophic loser away from taking yourself out of the business. And then another bonus that we get from preserving capital in such a diligent way is when we get these huge crash events in the market, we have preserved capital. We have dry powder to take advantage of just the best trading opportunities that come, the once in a decade opportunities that come after macro crashes, where we can scoop in and get things for pennies on the dollar, whether it be distressed debt or extremely cheap stocks, like in 2008 when Bank of America and large institutions like that were trading for a couple bucks, right? And then they 8x since then. Those only come around, every decade. They don't come around that often. And if you're buying in at the top and controlling risk on the way down, you're going to have dry powder to come back in and scoop those up when that clearance sale hits, instead of holding on to high cost basis holdings. Others who hold through the underwater with a high cost basis and little cash, they're not gonna be able to take advantage of the bargains. So they're in Bank of America near the top, right? And they got to take the whole drawdown, and then they got to wait through the entire run up. And even then, it's not guaranteed to get back to even. Instead, if you cut your loss, that you get the optionality of cash, right? That's what we refer to as the optionality of cash, where we can scoop these little stocks that are trading for $2 and trade them back up to 10 after extreme crises. So if you don't have dry powder and you're not controlling risk effectively, you're not going to be able to do that. So that's another bonus benefit from having an extremely diligent risk management perspective. And then finally, we're getting onto the emergent property, which is this analytical property that comes from combining price action and fundamentals. So the emergent property is a property which a collection or complex system has, but which the individual members do not have. So we believe edge in the market is created by combining different analytical methods and interpreting them together. So fundamental information at its core is best analyzed within the context of price action. And this is so key. It's within the context of price action, which is what makes fundamental information powerful. So here's an example. Say earnings come out in the Wall Street Journal, Bloomberg, CNBC. I'll say, oh, it was a really great positive report. But then the stock tanks in after hours. I mean, how many times have we seen that, right? We got strong reports, and then the thing just goes straight down. And what that means was investors' expectations were not met. Okay, they were looking for better results than what presented. So maybe the company made money. They might have had a positive EPS and positive revenue, but investors were expecting even larger positive revenues and more positive earnings, and the current numbers are already baked into the stock price. So what happens is the price data in context to the fundamental data creates this entirely new takeaway. And that's where we get this reaction to the news is more important than the news itself. It's the emergent property at work. So if we just looked at the fundamentals, say, oh, their earnings are pretty good in the stock, and we didn't even check the charts and we didn't look at the reaction to it, then we're not really going to get a good idea of the landscape of what are the other players in that stock thinking, and why are they responding this way to negative news. And the same thing with just looking at price data. If we just look at a selling off stock without the context of good earnings, we just have a completely different takeaway. So using this emergent property to combine the fundamentals with the price action can give you insights that are impossible by using either analytical method alone. So like I just mentioned on the last slide, right, we get insight into the minds of others if we use price in context of fundamentals. So the stock tanking is in response to good earnings. It's a sign that there's already too much optimism baked into the price. So now we know what everyone else is thinking out there in the field. We know how they're going to respond to further fundamental developments, what they're looking for. And then that will help us, shape our thesis, say, maybe I'm wrong about how far the stock can go, or maybe I should shift my fundamental thesis. But if you aren't paying attention to both of these concepts, you're never going to get that type of takeaway. So looking at price action or financial statements alone will never achieve that level of insight. And that's why looking at charts and understanding price is so important, because you get a whole nother layer and a whole nother source of edge by combining both analytical frameworks.